Bunches and bunches of folks joining us today. Lots to talk about. All right. Folks will be continue to join for a few minutes, but let me give you a start. We'll do a little sort of housekeeping logistics first. You will notice we have a few folks from the Altos team on the webinar with us today. So feel free to use the Q&A box for the little button at the bottom of your Zoom bar to ask questions along the way. We'll try to answer them on the fly or point you to links of where you can get your answers. That Q&A box will be up the whole time, so just keep that in mind as we're rolling. We're going to spend, probably 45 minutes today, and I'm going to start by showing our agenda. So we're going to start by looking at the data. October, this fourth quarter of 2020 is the craziest market we've ever seen. It's never like this in the fourth quarter. There are only a handful of things that are in sort of normal, seasonal patterns, but we're going to find out and we'll show you what those are and where they're different. We're going to use that data then to spend some time thinking about how to talk to consumers, buyers and sellers, investors in the market right now, or how to think about the market right now. We're going to talk about some conversations and some techniques all the way through. The biggest thing that we should spend our time on, and it's something that I have to be very careful about personally, is that the data is super bullish right now. Demand is high and prices are climbing and all of the things are really bullish. At the same time, we've got some crazy bad things in the economy. So does that mean there's a crash coming? We know that the whole mortgage industry is bracing for big distressed wave. What is that going to look like? We know that buyers are sitting on the sidelines with cash. So understanding the crash with an uppercase C is something we want to talk about. And we at Altos have a very maybe unique position on what that means and how to think about it. And then we're going to go switch over to some local data, look at the Altos reports in particular, and talk about how we're using that in the business and answer some of those questions along the way there. Okay, so let's start today with a poll. I am interested in what are the questions that you're hearing from your clients and prospects most? What are the opinions they're telling you? Go ahead and select a few of these and let us know the questions like, am I buying at the top of the market? Is it now? Or when is this crash coming, right? Well, this crash that everybody knows about. Everyone's moving out of the cities. Does that mean I should buy in the city or not in the city? Or, how fast do I have to act here? Should I offer over ask it? Here's a great question I just see from Lance in the chat. Is it 2005 all over again? Or the opinion is it's 2005 all over again. There's a lot of that opinion out there. And we'll spend a little time today showing why it's actually not 2005. It's a very different market. And then also how to frame that with your clients. So if you've got clients thinking, hey, it's 2005 all over again, how do we answer? What's different today? How do we show them? Excellent. Okay, so the answers are coming in, and this topic of when is the crash coming is on everyone's mind. second on our list here is why is it so crazy if the economy is in the tank? How can this possibly be? But really, this is great. So your clients are asking and talking about the same things that are sort of on our topic for today. So this is terrific, and we'll get into this and see exactly how to do it. You know, and really what we're talking about here is market data answers these questions. If you've heard me speak previously, you know that I say there's only three questions in for the real estate consumer. It's what's for sale, how much is my house worth, and how's the market? And all of these things are how's the market questions. They are, and we answer how's the market questions with market data. So, you know, when you take your Altos reports and you put them in their hands and you have them at the top of your stack for the listing presentation, the first thing that we want to be talking about is be ready to answer all these housing market questions. Is the crash coming? When is the crash coming? How do we act? Okay, so here, I'm going to end the poll now and I'm going to share the results. So 60% of us are talking with clients about hearing when is the crash coming? Or as the, you know, is it 2005 all over again? This fear of whether we're moving out of the top, buying at the top of the market, or, you know, how can it possibly be so crazy? And we'll talk about how it can actually be so crazy when, you know, even though there's so many things wrong with our economy right now. Okay, so awesome. Let's start diving into the data. The biggest story of the year is our critically low inventory. Available inventory of single family homes on the market is at 563,000 right now. This is this dark red line on the chart. Comparing that to our normal seasonal curves of the last 5 years, you can see this dramatically fewer homes for sale. And this is 41% fewer homes on the market than last year at this time. So what's fascinating is that this is all price points and essentially everywhere in the country. The only places where inventory is up is, and it's, you know, it's really interesting is, you know, that we have that question on the poll of you know, everyone's moving out of the cities. It turns out that that's only true in a really tight handful of zip codes in the most dense and most expensive cities in the country, basically San Francisco and New York City. In a handful of zip codes in the densest, most expensive part of downtown, people are moving out. So there's more condos on the market in San Francisco than there have been in years. Inventory of single family homes is also climbing. It is definitely true. However, what's really fascinating is if you look even at the region, even a little bit outside, all of a sudden, its inventory is tight and prices are skyrocketing again. So for example, I had a conversation with a colleague this weekend, and she lives in San Francisco, and she has been in the market for about a year and had been thinking about buying a condo in the city. Now she's shifted her sites to Alameda. Alameda is just on the other side of the bridge from San Francisco, and Alameda is nuts. It's crazy demand. And it's still super dense. It's just, it's a better deal than buying in San Francisco proper. So it's, with the exception of a handful of these really close in zip codes, it's pretty much true across the board. So this record low inventory, we'll talk about it, how this is a function of low rates, a decade of low interest rates, and then ultra low this year, coupled with the millennials who are now in peak buying age, and the fact that despite rising prices, homes are affordable because the rates are so low. One of the things that's the questions that we want to know here is this supply, is the supply function, the supply crisis, a function of just not having enough listings, or is it a function of demand? And it turns out that we know that our inventory crisis is mostly about demand this year. And one of the ways we know that is by looking at the new listings per week. So each week there's a new group of houses that get listed for sale. And you can see over the last 4 years, there's 70, 80, 90,000. At this time of year, it's about 70,000 homes coming to market. And right now in 2020, we have about the same number of houses coming to market as we normally would. So you can see the dark red line here is now right in this, just like it has been in this time of the year in the last 4 years. Yet Americans are buying everything in sight. So they buy super fast, and so we're absorbing more than we have, than we're getting on the market. So total inventory is falling about 1% to 2% per week, every week, all second, third, fourth quarter, with the exception of March. So we know that this is happening. You could see when the supply earlier in the year, April, May, was lower. The new supply was lower, but for the last couple of months, July, August, September, October, we're basically in a normal range. It's all demand. We're now in a window in October where we have a little transaction window. Normal years, school has started, and so there's a pullback at the end of August, beginning of September, as we finish up and get back in school, and then you have a little bit of an October window. Then we hit November, and really it's the week of Halloween. We get, boom, fewer listings and stuff that was on the market. Some of it gets withdrawn. You start to see inventory pullback through November and December. So we are going to lose total inventory in a normal sense through November and December. And then reset the second week of January. So first week of January is still New Year's, nothing, but then you start getting our first signal of the first quarter on the second week and third week of January. So we're going to go from 563,000 homes to likely under 500,000 and maybe, under 400,000, depending on how much absorption happens through the holidays, but really few homes on the market. Demand-driven phenomenon. And of course, record low supply, record high demand keeps driving prices higher. So this week in the US, the median home price is $352,500. Where this is the red line on the chart. And you can see we've had many years of climbing prices. The little blue dots here are the year over year spot. And you can see, normally we have our peak at the end of June. And then a little bit of third quarter pullback. We have an October plateau when some transactions happen, and then we'll have 2 months of, things pull back in the fall. And that means anything that gets listed new in the holidays tends to get listed at a little bit of a discount. And so that shows up here. And the things that have been on the market and didn't move often take price reductions. So that shows up here. So you can see that's the normal cycle. And then the second and third week of January, we start getting our market climb. The blue line on this chart is when we look at those homes that got listed in a given week, that 70,000 this week, where are those priced? And when we look at the price of new listings, the median price of the new listings in any given week, this is my favorite wisdom of the crowds example. In aggregate, sellers and listing agents know exactly where to price the homes. And they know, for example, that this year we did not see any demand pullback. You can see the demand pullback in the blue line here in March and April, and then boom, we went right back. And so when you go to list your house and you price it, you look around and you know, oh, there were multiple offers at down the street, and we know that they're going in 2 weeks. They didn't take a price cut, so we're going to price it a little more aggressively. We're going to try it, and you get more people. Some of that 70,000 right now are people who are testing the market. They say, well, maybe I can overprice this house and get what I'm asking. And so that the strong pricing is actually pulling new listings to market. I actually talked to a friend over the weekend who is listing his expensive Silicon Valley home to see what he can get. He's moving his family into a rental, and he says, we'll buy next year sometime. And he is one of the folks who is waiting for a crash. If a crash comes, can I swoop in and get a bargain? As you'll find out later in the session, I don't personally, in the Altos data, foresee any crash coming. And so we talked about that. And in his case, he doesn't mind if he gets a nice price for his home. Then he will use it as an opportunity to experiment with his family and move. So up 8% year over year. You'll notice in the next few months, the other headline numbers, things like CoreLogic and the Case-Shiller and the FHA home price indexes will start climbing from 5 to 6, 7, 8% to catch up with the Altos data. They're all looking at transactions that happened several months ago, rather than looking at what's going on right now in the market. And I can tell you, based on this data, that the transactions that are happening right now are happening at significantly elevated prices over August. So, for example, CoreLogic released their August HPI number today, and August in their number is up 5.9%. And let's see. So there are people in the waiting room. Let me see if I can let people in. I don't, Layla, I don't see people. I don't have a waiting room number for folks. If it looks like everybody, all the attendees are in as far as I can tell. If you maybe resend the link, Lael, to folks who say they're in the waiting room, the webinar link, they might be on a wrong link. Okay, so that's pricing. The expect the headlines to catch up to this 8% year over year gain through the end of the year. So, right now they're starting to say 6 to 7, and then you'll start seeing 8% as they get even more data in. As we know we've talked about this being a demand-driven market. And one of the most important things that we spend time with clients on is the days on market number, the time to sell homes. The selling normal days on market has a gentle, very seasonal curve. The way it works is, when things are transacting the fastest is in June and July, May, June, and July. And you can see this trough in days on market each year. Then in the third and fourth quarter, the market time climbs on average, meaning stuff is still on the market in the fall that was on. And so sometimes it's things that are overpriced, or they are like weirder, harder to sell, those kinds of things that stay on the market. So we see that. And then right at the second week of January, you get new stock and it starts climbing. And then in March, transactions really kick in. And so average days on market falls through the the June 30th before we start climbing again. And then here is the curve on the far right is the curve for 2020. You can see our little, things pulled off the market in March and April, and the stock pulled back, and like all the junk went away, and so it actually dipped. And then as demand has continued on, we have a weekly decline in the average time on market. Things keep moving faster and faster. This curve in October looks like it normally looks in April or May. Like it still looks like the second quarter. This is really bullish for transactions that are going to happen still this year and for pricing. It is also one of the factors that I cite with folks when we are talking about when is the crash coming. I'll show you what I mean by that in a few minutes. The crash must be coming next year. Days on market is one to keep an eye on in that sense. The other demand indicator to keep your eye on is price reductions. Percentage of homes on the market that have taken a price cut in the last 90 days. Very often we list homes as overpriced. Sometimes that's strategic, meaning, the client like my friend in Silicon Valley this weekend says, I'm going to see what I can get for my big overpriced Silicon Valley house, and I'm going to see if I can get it more overpriced. And so they list high. They intentionally list high. I've heard, some folks say, if you didn't take one price cut, you underpriced it. And so those are strategic overpricing. Sometimes it's a wacky seller who doesn't understand or doesn't care. Sometimes it's, we have to compete to get the listing, and we say we can get more for it as listing agents. So we pitch that in a listing presentation. There are a bunch of reasons that a house may be overpriced. As a rule of thumb, about 35% of the market takes a price cut before they sell. And as they are on the market, they take their cut and then they move. What that implies is if 35% of the homes think they're overpriced, then when we get in hot markets, especially at the peak, we've actually had pretty hot markets for most of the last decade. Home prices have been climbing since 2011. And so at the peak of the market in the middle of June, you'll see that price reductions are fewer and they've been hot markets all the way through. In 2018, it was hot, and then mortgage rates started climbing. So price reductions reached higher as demand cooled off in 2018. So you can see it got out to the top of this band of safety. If price reductions climb above like 40%, 45% nationally, that's a weakness signal for the market. And that means that 35% of us overpriced, but 45 had to take a cut. Half of the stock has to take a price cut. That is a signal that organic levels of demand are weakening, that the houses that are on the market are taking price cuts, and that means that transaction prices in the future are going to be lower. It means that new listings, as they come to market, they say, wow, everybody around us is taking a cut. We got to price this down a little lower. And so right now we are, again, normally in the fourth quarter at the peak of our price cuts because people are cutting prices to try to move it before Thanksgiving. Not this year. We're way low. We're way below the normal range, and we can see the peak. We can see it ticking up a little bit. So we're right around bouncing, around 25, 26% of homes with price cuts, as opposed to 35 to 40% normally this time of year. All right. Let's see. we have a bunch of folks in who are now joining, and I'm going to mute folks along the way as people are joining here. So, okay. All right. Well, thanks for, we have a bunch of folks joining who are joining as panelists right now. So I'm going to try to keep you joining. They got a link as they came in, and we're going to keep rolling on here. Okay. So let's talk about the crash. The mortgage industry, there's no question, is bracing for a big wave of April foreclosures. They are, so they see, we have had as many as 6.5 million homes in the forbearance program not paying their mortgage. Interestingly, this is where we look at the comparison with 2005, especially folks who lived through that crash, 2006, 7, 8, 9, 10, were very sensitive. And so home prices are skyrocketing. A lot of people are unemployed. There must be a crash. So how are we different from 2006, 2005? One of the differences is that in this year, we've had $700 billion of home equity gained as home prices climb. So valuations have been climbing almost all year. And that means even if you haven't been paying your mortgage this year, your valuation is climbing. You're gaining equity in this time when you haven't been paying your mortgage. And so as a result of the 6.5 million homes that started in the forbearance program, only 3.4 million are still in it. So 3.4 million is still a lot, and we still got a lot to work out in the next 6 months. There are still a bunch of homes, especially the FHA loan homes, which are still in forbearance or delinquent. They're not paying. 17% is nuts. The FHA loans are higher in this delinquent process because the down payment requirements are less. So they are so that because the down payment requirements are less, those loans are more likely to not have a lot of equity. The reason that you walk away from a loan, that you either have to short sale or you walk away entirely and you get foreclosed on, is because you can't sell the house. The reason you can't sell a house is because it takes too long and you don't have enough equity to support the price you need. To support the price you need is really a fascinating thing, right? Right now, because home prices are climbing so aggressively, and because time to sell is declining. Remember, we looked at our days on market chart. As the time to sell is really fast. Now, if I haven't made my mortgage payment, and I still don't, for example, have a job, or I've now recently lost my job, so where there's a big wave of some of the bigger companies, the airlines, the banks that are now starting to lay off folks. That has implications for the next year. But if you're in that case, we don't have to walk away and go into foreclosure because you could just sell the house and take your cash. So those options, and it's why 40% of the homes that went into forbearance have already exited. Either they're like, you know what, I got a really good deal. I don't want to foreclose. I'm going to figure out how to make my mortgage. Or you can sell and walk away with your capital. So the view from Altos Research is, as long as mortgage rates are staying low, And by low, it's really under 4%. If mortgage rates climb to 5%, and I'll show you this in a second, then we'll definitely see a pullback, and there will be bigger implications. But as mortgage rates stay low, time to sell is staying low, our price reductions are staying low. That implies that all of the folks, most of the folks that are in some kind of forbearance program, they're delinquent on their loan, have a really good opportunity to sell and not sell in a distressed manner. So our view is that you're going to see more rapid reduction of the forbearance program as we approach the deadlines, and that we're going to see very few of the actual foreclosures compared to how many it could be, and certainly compared to 2005, 2006. The other big, another big factors in that time. So we have record levels of equity compared to record low levels of equity in 2005. We also have record low rates, interest rates. So everybody has a cheap mortgage. You know, we've had low rates for a decade. Basically, everybody has a cheap mortgage. And this cheap mortgage, because it's a 30-year fixed, this is a cheap mortgage forever. In 2005, if you got a mortgage, you had a cheap mortgage for 4 weeks, right? You had like 4 weeks before things started resetting, and you know there were those like the very first mortgage payment was missed. There were all kinds of craziness going on in that market that is not present in this market. So while we have a lot of homes, to work out, we have also a lot to communicate to our buyers and sellers. So, when we're talking about, when is the crash coming? The likely answer is there is no crash. The risk will be if mortgage rates climb or if they spike. When mortgage rates climb, our demand is going to pull back. So if for some reason mortgage rates climb next year, that's going to be a bearish signal. The ultra low rates are driving our demand. It's a really, despite home prices climbing, having 2.9% interest rates makes affordable a lot of house for a lot of people. So that's the signal. And as of right now, it's, rates are low, they keep going lower. I have no idea when rates change. If I knew that, I would be trading mortgage rates, not real estate data. So it can be really difficult to know when that happens. This chart shows interest rates over the last few years. That's the dark red line. The blue line is the Altos Market Action Index, which is our at a glance, how's the market number? So as that number climbs, that's because demand is increasing and supply is decreasing. Those are super bullish. You can see that 2020 is off the charts. And, we know that, and we've been talking about that all day. So you can imagine this pull back, but we're strongly in a seller's market. So we are likely to get a little bit of seasonality in that next year. With any luck, we get some more inventory coming to market, although because rates are so cheap and it's affordable to hold, then I don't think we're going to get a flood. We could get some of these distressed folks in the first and second quarter next year that are distressed in that they like if the economy is not recovering, so those will hit the market and hopefully give us actually greater health than weakness. If you have clients on the sidelines who are saying, when's the crash coming? And I'm going to sit here and wait with my cash to be a vulture and swoop in for the bargains. My question to them is, how long are you willing to wait? Because the data, as of right now, there's no signal in it. There are places where we could see that it could happen, but it has not happened yet. Okay, let's switch. And I am going to switch to a view of some Altos reports. And in the reports here, so this is the Altos system. If you're a client of ours, you know, for the clients on the call, you know, for those who aren't, really quickly, what we're looking at here is when you're an Altos subscriber, you have your market reports for all the locations you work. This is my personal account and I've got them for all over the country, but you obviously have them for your local areas. You've got your contacts. This is your contact database. These are people who are getting the data from you on a regular basis, and which markets do they get? And then your email campaigns, which are the automated ways to put the market data in their inbox. You can see, like, we can click through any of these and do things like, you know, who's looking at Bozeman, Montana? And oh, Leslie's from Southern California and looking at Bozeman. Like, that's a real interesting move. We know that there's a lot of buying going on, and we've called them the Zoom towns, the second home market. And we can see that people are interested in buying. And this is my personal one. So, you know, we can see where people are going. On the crash, I was looking at some data from the Mortgage Bankers Association the other day. They ranked markets that they were seeing being the riskiest markets for a crash. They listed Houston, Atlanta, they had like San Antonio, Riverside in California. And what they did was, what percentage of mortgages, especially the FHA mortgages, are in delinquency, and how much of the market is that? What it shows is, in their estimate, you know, New York City, for example, has a lot of mortgages in the forbearance program. A lot of their FHA mortgages are not being paid right now, and in that sense, there's some risk. As a percentage of the market in New York, it's actually really low, because there's obviously a lot of homes and a lot of equity and a lot. So a percentage of having a crash market in New York is actually a really low risk. And this was according to the MBA. Now, what I thought we would do today is look at the Altos reports. These are branded for Mike, but you know, obviously our clients are always branded for you. And I'm looking at the Houston metro market with this report. So Houston was one that they identified has a larger share of the FHA loans, which are somehow delinquent right now, mostly in the forbearance program. And so what do we need to know? Is it likely that they will have to walk away because they can't sell their house? Or is it likely that they will actually be able to sell their house if come the spring, I still can't pay my mortgage, and now I'm in the oil industry and I also have lost my job permanently? So what happens then? Well, we know that we're in a strong seller's market. 45, it's actually not quite as strong as the country as a whole. So it's a little lighter there. And we know, of course, you know, the energy markets have been off and there have been layoffs there. So there is some opportunity there. However, we can look at the inventory in our Altos report here and see that inventory is still falling. We know that price per square foot has been climbing. We can see that our price reductions is currently at 31%. For Texas in general is usually higher than the country as a whole, because we generally have a greater supply of available inventory for the population. So country as a whole right now is at 26%. Houston's at 31%. And normally in Houston, you'd be at like 40%. So we can see where prices have gone this year. So, you know, Houston has had a strong year, just like everybody else. You can see here's the first few weeks of lockdown in pricing. But the rest of the year has been super strong. So that implies that while Houston has a high percentage of homes in the forbearance program, especially the FHA loans, that those homes have had good equity increases during the year, and that time to sell has been decreasing. So in general, you know, we don't feel super risky about Houston, especially like compared to, you know, when the bubble burst in 2005, 6, 7. Let's look at Atlanta. Atlanta also, Atlanta got hit hard in 2005, 6, 7. Atlanta is also a very strong inbound migration market. In Atlanta is at a 55 on the market action index, significantly stronger than where Houston is right now. And we also know that inventory has been falling. Days on market is just falling every week. Your price per square foot. So Atlanta, interestingly, was at the top of the MBA's risk market. But for us, we actually would de-risk it because the market is significantly more strong. And so we've had lots of equity increases over the year. 330 to 380 this year. So like a 15%, 14, 15% price gain. You can see a little bit when we look in the price range quartiles. And in your Altos reports, if you're not using your price range market segments when you're communicating with your clients, I recommend that you get familiar with the market segments right away, because the information is super powerful. It depends. The high end of the market may be behaving very differently from the low end. And in Atlanta here, the high end of the market is an 875. These are big lot, big homes, and relatively new construction. Days on market's 169. On the other hand, the cheap stuff, 200, 300, these are going significantly faster. And so as a whole in the region, you can see exactly where demand is happening. It could be that we find that one segment of these starts to get more impacted in the spring. If I had to hypothesize, I would guess that when we're looking at the low end of the market here, the 300 and below, that's where we're more likely to see our risk. These are ones that are more likely to have FHA loans with low down payment percentage, so you have less equity built up. And these are also more likely to have the economic trouble, to lose your job right now. So these are the ones that in the spring we'll want to watch. Is our days on market climbing? Are price reductions, if we look at the percentage of homes with price reductions and we look at it in the market segments, can we take out the high end of the market and just look at the bottom of the market right now? The lowest stuff in Atlanta right now, the cheapest stuff is only 21% price reductions. Like, these are moving super quickly. They're not paying price. But if this climbs, you can see normal times it might be 30%. If we see this spike next spring, it's because people are in trouble and these people need to move their houses more quickly, and the demand has fallen away here. So those are the signals, the leading indicators that you can, when you sit down with your client, you're in the listing presentation, you put your market report right on the top of that listing presentation. You say, look, here's what we're going to see. I know that we got to sell your house because we need to capture your equity, get your cash in your pocket in this crisis time when you've lost your job. And here's how we're going to know that we're in front of the market, we're ahead of everybody, and we don't get caught. So this is Atlanta as a whole. Let's do a couple of quick more ones here. Chicago is actually surprisingly strong to me this year. We looked, they're a strong sellers market. Chicago took a lot longer to emerge from the mortgage crisis of 2010 than other markets. But Chicago has had a super strong year, so price decreases are only at 27%. Days on market's a little bit longer to sell in Chicago, and that will definitely climb over the winter. But it's on this list here because the MBA cited it as one that was risky with a high number of FHA loans in a current delinquent state. Chicago looks strong at this point. Riverside was obviously one of the real heavy hit bubble markets. They had a bunch of the loans that were really lousy. What we have in Riverside right now is tons of equity gain this year. We have record low inventory. So if we look at inventory here, last year at 14,000 homes in the whole metro area, and, we're down to 6,000 this year. It is, if those homes have to come to market, they're moving quick. You can see exactly where the demand is at under 500,000. We are likely to be able to capture any of the equity that's there right now. So Riverside does not concern me at this point. It's really fascinating how the markets that got hit during the bubble crisis last time are actually very different from the ones that are risky at this time. Okay. Orlando is another one. So Orlando's a little bit lighter. It's still a strong seller's market, but in the 40s here. It's funny because that's so strong, but relative to the rest of the country, it's lighter. And you can see the price reductions climbing in Orlando to the mid 30s. So it's not uncommon for Orlando to have price reductions in the 40s. So this is hotter than normal for Atlanta, but also a little bit cooler than the rest of the country. Than Orlando. But cooler than the rest of the country. So Orlando is something to keep your eye on as a potential for weakness if demand falls off in the spring. Let me go to one more local data. Yeah, I mentioned earlier in the call a friend of mine who has been in the buyer's market for about a year. And she mentioned this weekend that she lives in San Francisco in an expensive apartment in San Francisco, and she was thinking about buying a condo. She has been thinking about buying a condo in San Francisco, and in the $1 million range. And she because San Francisco, some of those close-in zip codes of San Francisco right now are a little bit scary, and people are there's more inventory there, and there's more people buying outside. She said, well, how far outside do I go? Alameda is literally just across the bridge, and Alameda is off the chart strong sellers market, 78 on the scale. And she's interested in buying, and we're looking at, price per square foot. Price per square foot at Alameda at $700 is actually a lot cheaper than San Francisco. And then we go down and look at the price range segments. So as I mentioned, if you're not using the segments with your clients, you should, you should familiarize yourself with it right now. So we looked at this report. Natasha and I looked at this report and said, okay, what's your price range? She's like $1.25 million. Well, you can see in Alameda, anything over $1 million, 12, 17, 5 days. And anything under $1 million, these are the teardowns. And so exactly where the demand is going. You can see exactly where people have the opportunity to buy, what people are interested in. And so having that conversation with the client is that is our powerful opportunity with the data. I'm going to switch the share here, go back and wrap it up, and I'll take a look at we'll take a look and see, make sure we've answered any of the questions along the way. All right, as that's loading up, question from Bill about the CoreLogic numbers today. CoreLogic was interesting. They have had been predicting price decreases. So their models were they looked at overall average economic activity. And average economic activity is way down. So their models were saying price declines for 2021. They have changed that, Bill. And what they're finding is that everyone in our view, it's because the biggest, most hard hit parts of the economy, the people who have had the hardest time, were already priced out of the market. So their HPI today shows home prices climbing through August at 5.9%, and their forecasts are now positive for 2021. Okay. Let's see. Are there other, I'm going to zip back to the slides, and we'll just do a little bit of wrap up here because it is 10:50. Okay. Market data should be in every communication you do right now. I was talking with a new client, Altos client the other day, and he was talking about how he is now including his market reports in everything, every outbound email, all the campaigns on the website. And it's because people care. They want to know they're in the market, buying, demand is off the charts. So we want to be able to communicate with them. We want to be able to help them answer. But we also know that when is the crash coming is the biggest question everybody has. And so when we talk about it, we want to be able to say, here's how we know there's no crash imminent. We know that the homes are going in a super fast time, and there's actually super few on the market. The available inventory is another big difference between now and 2005. So while people are buying a lot of homes in 2005, there was also a huge pile of inventory, especially per capita. So as soon as they stopped buying, there was already too many homes on the market. It was masked by, flippers and things that were going through the paces, but but that's a big difference from now and 2005, especially when you look at inventory available per capita, like per how many people are in a zip code or a city or a metro, and the total available. We're literally at like a third of what they were. Like there were 300, 200% more homes on the market at that time. Very different market. We looked at the questions that the consumers keep asking. When's the crash coming? Can I get a better deal next year? Should I wait? Do I have to overbid right now? And as I've been mentioning, we don't bet that there is a crash coming. It is a good time to act now. And what I said to my friend Natasha is advice that I give all the time when people say, what should I do? Should I wait? Should I buy? Am I buying at the top of the market? The way I describe it is, if you find the house you love at a price you can afford, buy the house. If you don't love it, or if you can't afford it, don't buy the house. People bought the house in 2006 because they thought they had to get in, not because they wanted to live there. Now we have 30-year mortgages that are cheap forever. So this is how I described it to my friend Natasha when she was asking about should she buy in Alameda. And when she thought about it that way, she's like, oh yeah, I should buy the house because I have a cool one. And if it declines next year because interest rates climbed, your interest rate's set, you're fine, and you want to be there. So that's my general guidance on that. Okay, we have covered so much, and we can do a lot more, and we can spend time, especially if you want to do things like let's talk about how do I use this report in my listing presentation? How do I put this in my email to my clients so they understand that I know what we're talking about here? My recommendation is you go to altosresearch.com and you book a strategy session with our team. You can, in that session, we'll look at your market and we'll talk about your marketing and your framing. We also have an ebook coming out that will really help you talk about the, how you use the data in your conversations and in your marketing. So keep your eye out for that. Everybody on this call will get the invite to download that. That'll be coming up very soon. But make sure you go to Altos and schedule a strategy session. If you are not yet an Altos client, there's a bunch of people, hundreds of people on this call who are using it every day and who have had really powerful results because everybody wants to know. I had a client the other day who sent out an email campaign with a 55% open rate on his market reports because he was, it's like, what do I have to know right now? And everybody wants to know right now. So if you don't already have your market reports in your arsenal, get on that right away. Go book a strategy session with our team. And we will do look for our videos every week. We're doing quick videos every week on the data. So if the things start changing, you'll see it on our YouTube channel first. And if we see any of the leading indicators, you'll see it there first. We'll be doing more webinars, and of course, you'll have your own data in your reports. You can look at each week at your price reductions, at your inventory levels, at your days on market. You can work with your clients in the price range segments, the market segments. All of those pieces will keep you on top of the data. So book it now. And I hope to see many of you on board with us and talk more very soon. Thank you, everyone, for joining us today. I'll take a look. I'll stick around, and the panelists will stick around for a few minutes to see if we can answer some of the questions in the Q&A, and we'll see. Here's one from David. Let's see. If there's no further federal stimulus and unemployment remains high, does that increase the chance of a weak housing market in 2021? So David, if you're still on, that was high unemployment was one of my hypotheses that we would have a cratering market this year. Like, that was a big worry for me. What we've observed is that the people who are unemployed were actually already out of locked out of the housing market, so that the high unemployment rate has not at this point hurt demand. The number that I am far more worried about or sensitive to is interest rates. So if interest rates climb, that's when things become relatively less affordable. And that's the thing that we've got to keep our eye on, because that has certainly helped be the stimulus for demand this year, this crazy low rates. So David, I hope that was useful for you. So Rick, how is days of market measured? What we do is we're tracking the active market. So these are listing to absorption time to closing. It is a continuous days on market. So we watch homes when they get removed from the market and then relisted. We'll do a continuous days on market. And so it's also the whole market. So it's, if there's some junk that's been on the market for 6 months, it'll be, or a year, that the average will be higher because of that. Well, we have a median days on market too. So you can actually look at the difference between the average days and the median days. And sometimes when the median days is dropping and the average days is still high, that's because the good stuff is moving quickly, and it's a good signal of a transitional recovering market. It's kind of interesting. All right, let's see. Margie, if we're talking about pricing, let's talk on the phone. You can figure out what it covers, the things you want, you get all those things. Book a strategy session to know exactly what it covers, and we'll get all of that detail. All right, and thank you all. It is the top of the hour, so I am going to wrap this right here. Thank you all for joining us.